Okay, so welcome to the second part of taxes as related to the three sector economy and how government finances. So, the second method that is used by the government, of course, we are discussing taxes as the method of finance, and the second type of tax which is used is the indirect tax. So, in the indirect tax, as I said, the indirect tax is a tax on expenditure. Here, you are just transferring the burden on the person who's consuming the product. Okay, but please do keep in mind that the expenditure can be done either by the consumer or by the producer. The producer also needs things in the production process. So when he is buying, he is also um, spending money and paying more taxes, but he may be in a position to transfer this tax over to the consumers. Just as you go to a restaurant and you have food, but after you've had the food, then you say this is the bill, but this is the additional tax. Now, what is he doing? Basically, it is he who has to pay the tax. It is the restaurant that has to pay the tax, but he is in a position to transfer the tax burden on the consumer. So that is a quality of the tax. For a direct tax, you cannot shift the burden on anybody. In the indirect tax, you can the tax has been imposed on you, but depending upon the elasticity of demand, you can shift the burden on somebody else. Okay. So now let's look at, as I told you, the indirect tax is paid on expenditure and consumption. The more you spend, the more tax you end up paying. Okay. There used to be a time when cinema goers, their demand was pretty inelastic. It was the only entertainment, and it was an entertainment that people loved going to the cinema. It was a get together time. They used to watch movies, so it was very easy to transfer the tax uh, to the to the person who was watching the movie. So please do keep in mind the nature of indirect taxes. They are regressive in nature. They will hit the poor worse. Let's say that you are paying a $10 tax. Okay, you're paying a $10 tax when you are buying goods worth $100. Just an example. Okay, here on the screen there's the example of a 3% tax, but I'm giving you the example of a 10% tax. Now assume that the person is who's purchasing 100 goods worth $100, he's paying $10, and his income is $1,000. Okay, but now imagine a person whose income is $10,000. He will also pay $10 in tax on $100 purchase. But $10 as a percentage of 10,000 is a lot less than $10 as a percentage of 1,000. So the poor person who's earning 1,000 is paying a higher percentage tax, and the person who's earning $10,000, he's also paying $10 tax, but that's a much lower percentage than the person who has lower income. So please do keep in mind the percentage of this tax paid by the poorer person is always more, and therefore this is a regressive tax. Okay. So it has been argued that this is an unfair tax. Okay. uh, this hits the poor badly. So it is an unfair tax. So it depends upon which side of the argument you are on. S- uh, but there's another quality in this tax. Direct tax cannot be avoided. If you are earning income, then you have to pay the income tax. It cannot be avoided. But the indirect tax can be avoided by cutting down on your expenditure. If you don't want to pay the tax, then don't consume something you will save it. But again, that depends upon the elasticity of demand. Okay, here are some of the indirect taxes: duties, custom duty, excise duty, sales tax, entertainment tax, value added tax, general sales tax, also called goods and services tax. Okay, there are advantages of this. Indirect taxes do check the consumption of certain products. If you impose a tax on cigarettes, the argument goes that it can reduce the consumption of this particular product. Okay. Also, it is also a stabilizer in the economy. If demand for a product is too high, you impose an indirect tax, the demand may go down because people can go without the product, they don't have to pay this tax. Okay, the most important problem arises in economies where people do not pay their direct taxes. So, when people do not pay direct taxes, governments are forced to impose indirect taxes. And that is a problem with many developing countries. That those who are rich are not paying the taxes that they owe to the government. So in economies where tax evasion is high, you will find that the government has no option but to impose these taxes. Okay, it can serve some specific economic objectives like protection of industries, and its effects come in very quickly. uh, if you impose an indirect tax, does not mean that investment in the economy will go down. It's not a tax on wealth. It's just a tax on expenditure. It's a tax on consumption, um, and it causes no particular hardship to the taxpayer. In order to pay this tax, you do not have to fill long documents, and it enables the government to collect these taxes fairly quickly, especially from travelers. But indirect taxes have several disadvantages too. First one, I told you, they are regressive. Okay. Secondly, it does not create the indirect taxes do not create a ethos where people say that we have to pay taxes. They see tax as a burden, as a way in which the government fleeces them. So there is this negative connotation attached with this. It does not contribute to the development of a civic sense. And there is the ultimate problem, that if you keep taxing commodities, what happens? It contributes to inflation. The inflation goes up, and as we've already discussed, controlling inflation is the primary objective. It's a cardinal macroeconomic objective of the government. um, and what about constant variations in the tax? If there are constant variations in the tax, then we don't know what our cost of production will be. So it has an inflationary influence. Okay, once a government uh, removes duties from imports, how will it reimpose them? It's difficult to reimpose. The importers will clamor. So that there are these problems associated with it. For the ideal tax system, what is an ideal tax system then? I will breeze over this because I've already uploaded a video on this, and you can watch that. But I'll quickly let you know. So it has to be equitable. The four cardinal principles of a good tax system are uh, equitable. Those with high income should pay more, which means progressive tax should be there. Exemption should be there for the poor. Negative taxation should be there, where the poor are given some financial consideration. Um, 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 the the more there are different approaches though. Okay, the benefit approach. So the benefit approach is the more benefit you receive from the government, the more you will have to pay the government in taxes, which makes in a sense it makes some some basic sense, because you see, if more people are receiving, like in Europe, people receive a lot of benefits from the government, so there the taxes are also high. So this is the classical approach, which is not very applicable today. All right. Then the second thing in a good tax system is convenience. Okay, filing returns, knowing exactly how much you have to pay and where to make the payment. Then there is certainty. There are three areas in which a taxpayer must be certain: the payment, the period of payment, which period is he being taxed for, and the method of payment. There should be some level of certainty. And the payment of tax, the collection of the tax by the government should not be very expensive. You should not, the government should not uh, impose more taxes to collect taxes. Okay, so the method of collection should be economical, not very costly. Taxes should not hit people in such a way that they become discouraged from taking initiative in the economy. No, they should, as I said, first and foremost, there should be an ethos that I have to pay the tax. But then the tax should be such that people should not feel that it's a burden. They should be willing to pay, and they should not be discouraged to make investments in the economy. That's very, very important. uh, there should be multiple tax for the rich, for the poor. There should be multiple tax. And then there is another thing which is called double taxation, which is most prevalent in the corporate sector, where the companies are first taxed on the profit, and then when they declare the dividends, then they are taxed again. So this is called double taxation system, and this should also be avoided. It should be simple, and one-time taxation should happen. Okay, so. So normally what happens here is that in order to avoid this situation, governments try to tax only the profit that has been initially made. Okay, and I think so. That's it. Convenience. It should be such. If it is inconvenient, if it's heavy, if it's burdensome, then the natural consequences that people are going to try to evade taxes. Okay, and that is something that the system should discourage. And it should things should be made easy, both for the government and for the taxpayer. Okay, so please go through this, and I hope that you understand this and you understand this well. See you in the next video. Thank you very much.